Hello, this is Chuck Carvin. I'm the Chuck in the Markets Up Chuck, and today's blog was titled "To the Max," and I wanted to show the graph on TJ Maxx or TJX companies, as it's called now, which of course you all probably know is a discount retailer. The reason I wanted to show this chart is this is a very healthy company, pays a nice dividend, pays about a 1.3% dividend yield. But the long-term, the 20-year performance chart on TJ Maxx is really quite interesting because it's really almost a tale of two companies. If you look at the first 5 years here, I want you to notice that TJ Maxx earnings were, rather inconsistent and rather low. And remember, on 20-year charts, I skip every other year because I don't have room to type in all the numbers. But the bottom line is, I want you to notice that the black line and the green earnings line correlated almost perfectly during this 5 years. And then really starting in 1996, TJ Maxx began to build some pretty good earnings, or TJX as it's called today. And I want you to notice the black stock price followed that. But here's the point. There are times when the line got above earnings. That represents overvaluation, and it almost immediately or eventually came back. Then there are several times here where the price is below earnings and it always comes back. But clearly over the longer term, you can see the stock price, follows it. Now this is a very important point. During the recession, this company's earnings flattened out a little bit, but they actually did quite well because of the nature of the type of retailer they are. But you want you to notice their stock price fell precipitously. But the point is the company was still worth what it was before the stock price fell, and so the recovery here was very, very strong. And part of the story that I want to tell here is that it never makes sense. A lot of people like to use stop losses. I personally don't like them because if I have a company that's still creating value and the price drops because of fear or panic, then I don't think it ever pays to sell something for less than it's worth. And if anyone that would have sold TJ Maxx or put a stop loss here would have sold at a loss, and then would have missed the opportunity for the company to recover. You can see the long-term record of this company is exceptional. It's done significantly better than the stock market. The dividend record of this company is also quite good. It's increased dividends literally every year for the last 20 years. But the point is that I want to really make in today's blog is look how the price and earnings correlate so closely. And that's really the moral of this story. In the long run, what's really important is the earnings of the company. So I often even will take these charts and I'll take the price line completely off of the chart. And the reason I do that is I want to look at the company from the perspective of what's the business like. And that's what this chart here is showing. There's no price on here. When I see a picture like that, I know that I'm looking at a very, very good company. If I look at another retailer, for example, like JCPenney's over a similar time frame like this, and I clearly see that you have a company here that has very, very erratic earnings. So I'm always looking at the earnings more than I am the price. And by the way, if I add price line to the JCPenney's chart, you'll notice once again that this correlation of price and earnings is real. There was, obviously the price kind of followed and tracked what earnings did over time. This is Chuck Carvin. It's Friday. As usual, I'll be taking the weekend off, but I appreciate everyone who's been tuning in this week, and look forward to talking to you again next week. Y'all have a great weekend. Thanks for listening.